You've heard the term flight to safety. There's a new term, flight to crap. The person who coined that phrase, I believe who coined that phrase, Steve Sosnick, joins us now. And you should know that he is the Interactive Brokers chief strategist. Good to see you, Steve.
So good to see you too, Adam.
Okay, flight to crap. What are the dangers for those who are taking a front row first class seat?
Well, the way I look at it is, we all know about the flight to safety, and we saw the huge flight to safety trade that went on February, March. And I was trying to think of what is the inverse of that, because that is what we're seeing. And I think that I had no better way to explain the rush that we've seen into stocks that are bankrupt, or stocks that have no earnings, or just these insane moves that we're getting in stocks. Occasionally just some weird mention will happen and a stock will triple. And I needed a way to rationalize this, and it was really the only way I could come up with it. I think the dangers are, there's a reason that people invest in a way they do. And I think when you start to chase returns without regard to risk, that is basically greed taking monstrous precedence over fear. And that is a very dangerous situation when that encompasses the market overall.
Well, Steve, it's Julie. Hi. The sort of poster child for this whole situation has been Hertz, right?
Yes.
This is a company that filed for bankruptcy. A bunch of speculators bought it up like crazy. Then they said they were going to sell more stock. Now there's a report today that the Securities and Exchange Commission is concerned about that stock sale. It's not clear if they're going to stop it, but they're concerned about it. I mean, are we making, though, assumptions about the savvy of these small investors? In other words, couldn't they be getting in and out quickly and making money? Are we convinced that, is the smart money really so much smarter than these small day traders?
Well, let's be clear that you can make money in even the craziest situations. Even in a bankrupt stock, you can't really short them either, because the stock loan becomes prohibitively expensive. They get subject to short squeezes. So yes, you can actually see bumps up in stocks that are bankrupt. The problem is when reality punches you in the face and you still don't really see it. In the case of, let's say, Chesapeake, which had a 1-for-200 reverse split a couple of months ago, the stock, was trading in the teens. I really don't know why, because it was clearly about to go bankrupt. And then the stock shot up to 70. And later that day, they announced that they were going into Chapter 11. They were going to begin Chapter 11. They haven't really began it yet for legal reasons. But then the stock fell back to the teens. So somebody made money on the way up. Somebody got clobbered on the way down. The bond market is your clue here. And if you have access to the bond quotes, you can see that in many of these cases, the bonds are trading at pennies on the dollar. In the case of Hertz, it's kind of bumped up to about 45 cents on the dollar, because the bondholders' recovery improves if they can sell stock, right? There's more, the bondholders own the company. If they can get $1 billion or so into their coffers, it helps their recovery, but it doesn't help stockholder recovery. The SEC should have been worried about this weeks ago, because if you're selling something that's fundamentally worthless, and in bankruptcy, if the bondholders don't get paid, the stockholders don't get paid. I don't understand how the SEC could allow the stock sale of somebody to sell stock in something that they know really is worthless. That's complete dereliction of duty. Sorry to call them out like that, but that's how I see it.
Hey, Steve, it's Kristen here. Good to chat with you again. So I understand your warning about this flight to crap, so to speak. But look, if you are a new investor, you've gotten excited about how cheap some of these stocks are. Essentially, how should you be trading through the rest of the year, particularly considering that we have potentially some headwinds coming up in the market, for example, a second wave of coronavirus? If you're a new investor, exactly how should you be approaching the next couple of months?
Well, I would think as your new investor, you should be de-risking a little bit. And I think what happens is, it's normal. It's human nature. We're seduced by the profits, not necessarily cognizant of the risks. And when you hear all these stories about, there's all this money to be made, people do it. Unfortunately, markets charge tuition. They always have. Every investor who's been around for a while has learned expensive lessons about when to embrace risk and when to avoid risk. And the problem right now is, I think people are embracing risk without real being cognizant of how much risk they're taking on. That doesn't mean that what they're doing is foolish or silly, but I think you need to be in a balanced approach. The other thing also is, as an industry, we've never made it easier for people to invest. Between free commissions, fractional shares, we've made it really easy for people to get into the markets. I think, again, the selling point is always how much money you can make. Remember also, you're not making any money by leaving it in the bank. So I think a lot of people are incentivized to chase the profits without, while sometimes leaving a lot of the risk management lessons that are learned over time without really getting them yet.
Hey, Steve, it's Julia LaRoche. Good to talk to you again. How do you think this ultimately plays out? Are we past that kind of point of no return? Because you just brought up, it's never been easier just to use your smartphone, put some money to work in the market. This retail investor boom, if you will, you see something kind of on the where, flight to crap could turn out very badly. I mean, is there anything that could change this? Do you think we'll actually see fundamental changes? Maybe the SEC do something about it?
Yeah, I mean, it's tricky. I would like to see, again, I think the Hertz example is one. I think at some level, let me be clear, I don't want to discourage new investors, the lifeblood of the industry, and I think it's good that ordinary people are getting involved in the stock market. I just want them to be careful how. The other problem I see on the horizon potentially is a lot of the money came from the stimulus package, directly from the stimulus. Some of the timing and the amount of new accounts completely coincided with the money that arrived in people's bank accounts. $1,200 checks, depending on income and stuff.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.